For retirees, the end of the year represents an important milestone, not in the way that we should pat ourselves on the back that we reach the end of the year, but rather a milestone in the way that there are important things that you should be doing before year end. In today's video, we're going to talk about 11 of those things. Number 1, review your spending capacity. All things considered, 2024 is a great year in financial markets. And because of this, even if you are retired, there's a good chance your portfolio is at or near all-time highs. Now, many people set their spending goal or capacity when they first retire, but then unfortunately don't revisit that on a continual basis. And ultimately, this means you aren't getting the most from your money. If your portfolio is up 10% from when you retired, and you're obviously a few years older, then any way you calculate it, your spending capacity is higher than when you first retired. Now here at Safeguard, we use a guardrail system to judge spending capacity. If a retiree hits an upper guardrail, we have a data-driven way to show them how much more they can spend. On the flip side, if we say a 20% drawdown in the market in 2025, that specific retiree might feel like they should really be cutting back on their spending, but their plan might show otherwise. We want the data to inform the decision making, not just the emotion. Now, the way we plan for dynamic income with clients can be a bit more calculation heavy and therefore require software. But DIYers can use a simpler solution and still obtain some of the benefits from a dynamic income approach. For instance, the table on the screen shows safe withdrawal rates based on the intersection of equity exposure to estimated years left in retirement. For those that don't know, when we talk about the term safe withdrawal rate, it's usually defined as the most you could withdraw in the worst case scenario. Given this, the safe withdrawal rate is a conservative calculation. It's also important to note that this is not meant to be how much you can take out each year, but rather how much you can continually take adjusted for inflation. What do I mean here? So $1 million portfolio with 60% stocks on a 30-year time horizon can generate, as you see, $38,000 per year inflation adjusted. So the following year, you'd take $38,000 plus whatever that inflation adjustment would be, and you'd so continue that into the future. Well, rather than just looking at the safe withdrawal rate once, you can use these safe withdrawal rates as a lower guardrail of sorts to inform spending. Let's say you retired 5 years ago with $1 million portfolio and we're pulling that $38,000. Notice the shorter your time horizon, the more you can spend. This obviously makes sense. Well, let's say our portfolio has grown to $1.25 million. If we look at the safe withdrawal rate on a 25-year time horizon, you can safely spend 4.3%. Well, that would lead to $53,750 as a safe withdrawal rate based on that portfolio size. How much more can you do with those extra funds? We shouldn't just set our spending once in retirement. That's rarely the best option. Now, it's worth noting this method only really works if you're already on Social Security, because prior to Social Security, your withdrawal rate's likely going to be a lot higher because you are filling in the gap completely with portfolio withdrawals. Those prior to Social Security will need to use a more in-depth method. Number 2, as you age, as you become more comfortable in retirement, and as your goals change, you should reassess how this changes the objectives in your plan. This is intertwined with reviewing your spending capacity. At the end of the day, there are really only 3 things you can do with your money. You can spend it yourself, you can pass it on to other individuals, or you can give it to a charitable cause. Every dollar in your plan has a purpose, and you need to decide what that purpose is. Do you want to spend all of your wealth yourself? Okay, well then you really need to be spending your plan's capacity to actually draw down your assets over time. Do you want to give money to the next generation? Great. Do you want to do it while you're alive or pass it all on when you pass away? Is there any amount that you feel like would be too much to give to your heirs? I think some retirees view this as a pointless or flowery exercise. Just show me how much to save on taxes and make sure I can spend my monthly income goal. In opposition, I view this priority setting as arguably the most important step in the whole planning process. Say you have no heirs and are not charitably inclined. You want to spend $10,000 per month. Now, based on your current spending capacity, you can conservatively spend $14,000 per month. And we estimate that will continue to grow to being able to spend $20,000 to $25,000 per month in today's dollars later in your plan in most simulations. After showing you this, you might say, holy crap, there's no way I can spend that much per month. Well, if that's true, then why are we taking the risk for growth we aren't going to use? This one insight might make us completely adjust our investment allocation to a safer, smoother ride. After all, we don't need the excess. Your goals and money psychology are going to change through life. It's important to reflect on what has changed and what it means for your plan. Number 3, review your annual tax graph. As we go through this video, I'm going to link to complimentary videos and resources in the description down below to further explain topics that I have to shorten the explanation on just for the sake of time in this video. The most important tool we use in tax planning on a year-by-year basis is the one I'm showing on the screen. This is a tax software that graphs out your marginal tax brackets based on your unique situation. The software that we use is called Holistaplan. Let's take a look at why this is so valuable. This is a single retiree who recently started their RMDs and they live in New Jersey. They have an IRA worth more than $1 million and a decently sized non-qualified account. You can see their expected income breakdown on the screen. Now, this marginal tax graph shows their situation after uploading in the annual expected income. So any additional IRA distributions or Roth conversions will be taxed at the rates shown on the graph. The problem I find with too many retirees is they don't have access to the right information and therefore won't take small steps to put themselves in a better position in the future. For instance, we know this retiree's RMD will only grow in future years, pushing them into various IRMA brackets while also forcing them into higher marginal rate zones. This is called RMD creep. Your RMD generally grows through life. Now, even though this retiree is taking RMDs, there is still room for RMD reduction in the future. A no-brainer move would be to do a $20,000 or so conversion that brings them right up to that first IRMA threshold, but not over it. They are paying a very reasonable tax rate to do so, and that $20,000 conversion, yes, it isn't massive, but it will help minimize future RMDs. We might even find that they want to move into the yellow zone for a slightly larger RMD reduction. But we can only determine this if we can accurately show where they are sitting today and the tax impact of said conversion. Take a look at another situation, this time a married couple in North Carolina with big taxable accounts. They have not yet filed for Social Security and are living primarily on their taxable account. Based on their expected income, we find this couple has about $30,000 of conversion room remaining in the 12% bracket before seeing a capital gain bump zone that is shown in red. Again, this is likely a no-brainer Roth conversion. But we also need to weigh this against capital gain harvesting, which happens to be point number 4. Look at your gain and loss harvesting abilities. Capital gain harvesting means intentionally selling gains at a reasonable rate in order to reset your cost basis. If we look at this couple's capital gain bracket, we can see they have about $35,000 worth of harvesting room in the 0% bracket. Only state taxes here would apply. It would be a massive mistake for this retiree to simply leave their expected income as it sits today. Now, I'll talk less about tax loss harvesting just because many investors this year will find themselves with more gains than losses. But tax loss harvesting opportunities should also be looked at here. It's basically the opposite of a tax gain harvest. Basically what you do is you sell a position at a loss and you're able to offset not only other capital gains, but also offset your ordinary income to some extent. Number 5, if you have mutual funds on your taxable account, those mutual funds might force a capital gain distribution at year end. The reason for this is because mutual funds are a pass-through entity, where any changes made by that mutual fund manager, like selling stock ABC to buy stock XYZ, can trigger a taxable event that again is passed on to you. These taxable events are offset throughout the year, but then capital gains are released at year end. Index mutual funds tend to have lower or no capital gain distributions, where active mutual funds often have pretty sizable distributions. This is critical to factor into your tax situation, as you might look at your annual tax graph and submit a $20,000 Roth conversion, only to find out a mutual fund in a taxable account also released a $4,000 distribution. And well, now you're subject to Medicare's IRMA. Luckily, fund companies publish capital gain estimates before year end. Here's one from 2023. If you held $100,000 of Vanguard's prime cap fund, you are set to have $5,000 to $6,500 added as a capital gain distribution at year end. Again, depending on the share class. Make sure you know about this ahead of time. Just Google Vanguard 2024 year-end capital gain estimates or whatever the fund company is and find out. Number 6, the year end is a great time to review safety needs and add additional safety if needed. This is specifically true when we are near market highs like we sit today. Here at Safeguard, we set safety allocations in a portfolio based on future cash flow needs. Start with an income goal, add in taxes, subtract out guaranteed income, and that will give you your annual portfolio need. We generally then want to set safety tranches anywhere from 4 years to as much as 10 years, depending on the specific retiree. Well, as we consume a year of safety, adding additional tranches to maintain that safety goal horizon is an annual exercise, specifically near market highs. Also, when managing a real retirement portfolio, needs and goal spending can actually change. Maybe a home repair comes up that will need to be dealt with in the next 2 years. Maybe you've just seen your growth outpace the safety and now you need to rebalance back to your target allocation. Again, where your growth portfolio should be sitting right now is a great time to make those adjustments. Don't put this off just to find in 2025 we're in a less ideal market and now you're caught out exposed to volatility. Number 7, now is the time to take your RMDs or risk a sizable penalty. Now keep in mind there are multiple RMDs that you might be subject to. The first, RMD is based on your account. In every other year than your first RMD year, you will need to withdraw the correct RMD amount by December 31st, or again, risk penalty. Note, however, you do receive some leeway in your first year. Say you turn 73 this year and must begin RMDs. You actually have until April 1st of next year to take this first RMD. Wait, however, and you will need to take 2 RMDs in 2025. Most people, regardless of the first RMD year or the 10th RMD year, will find that taking their RMD by December 31st is best. Now, let's say you inherited an IRA this year from a passing parent. Say that passing parent was also taking RMDs and passed away in March. If that parent took an RMD prior to passing, good news, you're all good. You will not need to take any additional RMD this year. But say they passed away before taking their RMD. You now need to take the RMD by year end on their behalf. The kicker here is it's going to go on your tax return. Number 3, in all future years, if you inherited an IRA post 2020, you will now have an annual RMD and need to withdraw the full balance in addition to this by the end of year 10. For instance, let's use the last example of mom passing away in March. You inherit her $200,000 traditional IRA. Starting in 2025, you'll have 10 years to fully empty this IRA, and you will need to take a small RMD each of those 10 years. Each RMD has a December 31st deadline. Now note, these annual RMDs were not required from 2020 through 2024. However, starting in 2025, they will be required. Yes, I know, these RMD rules can be quite convoluted. Number 8, have you messed up paying taxes throughout the year? Well, you may be able to fix your mistakes here at year end. For those that don't know, when paying taxes from a taxable account, either because of Roth conversions or other things like dividends, capital gains, you need to be making those payments throughout the year. There are 4 quarterly deadlines in which you must make estimated tax payments in order to avoid underpayment penalties come next tax season. So say that you perform a $100,000 conversion, but you don't pay taxes on that conversion until next April 15th. Well, unfortunately, you will probably have some tax underpayment penalties. Alternatively, if you withhold taxes from IRA or Roth distribution, the IRS treats withholdings completely differently. You could generate all of your income for the year in January, withhold absolutely nothing, then wait all the way until December 31st and initiate an additional distribution that withheld everything you need for taxes. And the IRS would have no issues with this. No penalties would be incurred. Withholdings are assumed to be equally held throughout the year, where estimated taxes are assessed based on the timing of those payments. You can use this to your advantage as a sort of get out of jail free card. Maybe you missed earlier estimated tax deadlines and are facing an underpayment penalty. Well, you may be able to do a distribution at year end and withhold the taxes you need and avoid all the penalties that you would otherwise incur. Number 9, year end is often the only time you are able to adjust your healthcare package, whether that be Medicare or Affordable Care Act insurance. Both open enrollment periods are in the last quarter of the year. Now, you may qualify for a special enrollment period, but the open enrollment periods are at the end of the year. Outside of special circumstances, whatever you choose during this period for coverage is locked in. I see a lot of retirees simply rolling their current plan to the next year, but this can often be a problem waiting to happen. Your needs can change year to year, but so can the offerings. Each year, make sure you are working with an insurance agent and reviewing which policies are best for you, judged on both a coverage and cost basis. Number 10, if you are planning on gifting, either to charity or to the next generation, I think the best time of the year to assess your gifting strategy is end of the year. You have options in both the amounts you gift, but also the way you gift, and not all gifting strategies are created equal. Let's first talk about charity. I see a lot of retirees gift a specific amount each year. For the sake of this example, let's say it's tithing to the church, and so you gift $12,000 each year. Well, unfortunately, you need to itemize deductions to gain any benefit from a gift. And because the standard deduction is so high right now, most people aren't gifting enough for those itemized deductions to be greater than the standard deduction and aren't gaining a tax benefit from that gift. Instead, you might want to consider batching your gifts and using a donor advised fund. Batch together 5 years worth of gifts either now or in the future and gift $60,000. This bigger gift will make it easier to benefit from itemization. Then the benefit of gifting to a DAF is that you can invest within that DAF and release those gifts as you see fit. Ultimately, you can gift the same amount each year, but gain a better tax benefit. Now, donor-advised funds are great, but if you're of a certain age, a qualified charitable distribution is often the best option. Donor-advised funds require you to gift cash or assets from a non-qualified account, where a QCD allows you to gift directly from your IRA with no need to itemize deductions. So $100,000 gifted eliminates $100,000 from your IRA free and clear. The one thing to note here is you can't QCD into a donor-advised fund. It has to go directly to the charity. QCDs, however, alleviate some of the need for Roth conversion. Also note that you can QCD away your required minimum distribution. Then when gifting to your kids, a simple block and tackling strategy is to use the annual gift exclusion. This is currently $18,000 per recipient per giver. So a couple could give $36,000 to one child in 2024. For those that worry about having assets beyond the estate tax exclusion at the end of life, annual gifting is the easiest way to avoid this hefty tax. Now, you can use this exclusion in a lot of different ways. You can gift straight cash, which, well, is straightforward. But you can also gift highly appreciated stock. Say you have Apple stock that has grown massively and is both too large a position in your situation, but too costly tax-wise to exit. Your child may be in a far lower tax bracket. You can gift the appreciated stock to them, they can sell it and just keep the proceeds, and you just save significantly on taxes. If you don't want to gift outright for fear of poor utilization by the recipient, you can also look at gifting into a trust. That way you can put constraints around uses of that trust. That being said, it will need to be an irrevocable trust to qualify for that annual exclusion. Then finally, number 11, if you have some small earned income and the ability to contribute to retirement accounts, make sure you initiate those contributions. Keep in mind, most contributions do have an April 15th deadline, but you really need to decide on contributions by December 31st to effectively plan this year. Here's a common error I see from investors. We have a retiree here with sizable IRAs, and because of future tax concerns, they're converting heavily from their IRA and filling up the 24% bracket. But this retiree also has a hobby business that earns $16,500. Too often I see this type of investor not want to contribute to a traditional IRA because they already feel like they have way too much in IRAs. That's, after all, why we are converting. For instance, if this retiree paid taxes and contributed that income to a taxable account, this income just ends up in an inferior account for the long term and eliminates some of that conversion room. Instead, this retiree should look at contributing to a retirement account. In the case of a traditional IRA or 401k, they receive a deduction. This effectively eliminates that income and allows them to perform a larger conversion than contributing to the taxable account. Ultimately, what happens here is they're getting the same net conversion from the IRA before they earn that $16,500. But now, rather than contributing that $16,500 or whatever that would be after taxes to a taxable account, they're contributing it to an IRA. They're opening up that additional conversion room, which basically allows them to immediately convert that right to Roth. Ultimately, that $16,500 after taxes goes to a Roth account rather than to a taxable account. They could also just contribute straight to a Roth 401k outright. They have the same tax effect as the taxable account, but again, are able to contribute to a better account. There are also some HSA contribution mistakes that I frequently see. If you look up the 2024 contribution limit for an HSA, the family limit is $8,300 plus a $1,000 add-on if you're over the age of 55. This is misleading, however, because this is the limit assuming you are contributing just to one HSA. A couple, however, can break that one HSA into two and gain the added benefit of an additional $1,000 contribution. Again, the deadline for contributions is April 15th, but you should really decide on this contribution in the respective tax year. It's worth noting once on Medicare, HSA contributions are no longer allowed for that individual. So there you have it. 11 things every retiree should do or consider before year end. Now in point number 1, I talked about reviewing your spending capacity. And at least at the end of this year, there's a good chance that your spending capacity has gone up. What is the best way to utilize this higher spending to benefit your life or the lives you care most about? Well, in this video right here, I have 5 categories of things you should aggressively spend on in retirement. Click here to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.